Why would you sell Bitcoin for fiat currency if you implicitly believe that the US government and every other major government is going to increase the amount of that fiat currency ad infinitum? That's the reason why you got into Bitcoin. We have a diminishing supply of freely traded Bitcoin with an expanding supply of fiat currency looking for a home. And if we believe that more people are changing their mindset to say, okay, crypto, it survived 15 years, it's going to be here for another 15, 20, 100 years, whatever. I feel okay thinking that this is going to be a store of value. I can use it to pay for things when I need. Therefore, I'm going to take 2, 3, 4, 5, 10% of my retirement income or savings and now start buying this asset. And so all these things come together, and that's what creates a marginal price of $1 million per Bitcoin.
Bitcoin's fixed supply stands in stark contrast to the ever-expanding supply of fiat currencies. Hayes discusses how institutional adoption, driven by entities like BlackRock and Michael Saylor's MicroStrategy, has created a sticky holding base. These entities, alongside long-term holders, are unlikely to sell their Bitcoin holdings, particularly in an environment where fiat currency supply continues to grow unchecked. Hayes envisions a scenario where more individuals and institutions allocate a portion of their savings or investment portfolios to Bitcoin. This shift in mindset, coupled with limited supply, sets the stage for an exponential rise in Bitcoin's price. Hayes projects the possibility of Bitcoin reaching $1 million per coin within 3 to 5 years, driven by these dynamics.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The first thing people need to understand is that the price on the screen is the marginal price of the last trade. It's not every trade that's happened. And so it's the simple example is, how do you become a trillionaire? Well, you create some fictitious company with 1 trillion shares, and then you sell one of them to your friend for $1. Now you're a trillionaire, right? The marginal price is $1 on 1 trillion shares, therefore you're a trillionaire. So I'm not saying that there needs to be, $1 million traded every day at that Bitcoin price. I can see $1 to trade at $1 million, and that's $1 million Bitcoin. And that informs our psychological perspective on what we think Bitcoin is worth. So with that in mind, what I'm talking about is the marginal flows into Bitcoin. Well, the supply of Bitcoin is fixed. We know 21 million will ever be produced. However, as you have people like BlackRock, Michael Saylor at MicroStrategy, longtime holders like myself and others, people who are just getting into the game now and believe in a future path of Bitcoin over the next 5, 10, 15, 20, 30 years. Are they going to sell? Why would you sell Bitcoin for fiat currency if you implicitly believe that the US government and every other major government is going to increase the amount of that fiat currency ad infinitum? That's the reason why you got into Bitcoin. So as the price rises, there's less people who want to sell it. And if we have this institutional adoption through the ETFs and other sort of corporate finance vehicles, those are sticky forms of holding, which take supply out of the market, which means it's very easy to have a very exponential rise in the marginal price of Bitcoin, the last traded price of Bitcoin. And so I think that's one facet of just how a microstructure of a market works when you have a fixed supply and a holding base that doesn't want to sell it against an asset that can be infinitely debased. And then the other side, you have the United States trying to reshore industry, issuing credit. You have China has a property bust, and they want to protect their industry, and they're starting down the path of quantitative easing. They just recently announced that they're okay with allowing their currency to depreciate because they believe it's going to help them in their fight against the new Trump 2.0 tariffs. You have the European Union, statesmen like Mario Draghi and Emmanuel Macron openly saying that we need to print more money to revitalize the European industrial base. And you have Japan, which continues to run the easiest monetary policy of any major developed nation. So if you take a look at the entire world in terms of the largest 4 countries and economic blocs, they all are printing money for various different reasons. that's only going to continue. It's accelerating, in fact. And so we have a diminishing supply of freely traded Bitcoin with an expanding supply of fiat currency looking for a home. And if we believe that more people are changing their mindset to say, okay, crypto, it survived 15 years, it's going to be here for another 15, 20, 100 years, whatever. I feel okay thinking that this is going to be a store of value. I can use it to pay for things when I need. Therefore, I'm going to take 2, 3, 4, 5, 10% of my retirement income or savings and now start buying this asset. And so all these things come together, and that's what creates a marginal price of $1 million per Bitcoin.
How fast do you think we get there?
I don't know, 3 to 5 years. Well, people are foolish to like the high volatility and have a high frequency of trading. So what you described is somebody who was actively trading in a very volatile situation. There's a very simple example. It's called Volatility Drift. This is why you should never, ever, ever buy any leveraged ETF. They're terrible products. I should know, I've structured many of them. So you essentially, if I take something that's 100, such a nominal price of 100, and it goes down 10%, goes down to 90, and then I go up 10%, I go up to 99. So I've, on an arithmetic basis, gone down 10%, gone up 10%, but I'm down $1, right? That's volatility drift. And so when you're day trading in and out, in and out, in and out, or using these products that are sort of these daily volatility resetting products, you're exposing yourself to what we call negative gamma or volatility drift, and that's not good. But if you say I'm a buy and hold type of person, you're the Warren Buffett type of person, and you're going to compound over time by systematically trying to reduce your total, your expected loss if you get it wrong, but just keep stay in the game. If you stay in the game, then over time you should do well. But the more you trade, the more money you lose. And that's just a fact. And so I think the fallacy is, oh, I like high volatility. I want to go to the financial markets casino and start trading. And then obviously you fall prey to the simple nature of, like, as humans, we have no idea what the future holds. And so trying to trade in sort of like a very short time frame is a recipe to lose all your money. Of course, there are these few traders out there who are the standout exceptions to that. And then they're sort of paraded across the financial mainstream media as, oh, look what this guy did. He turned $1,000 into $1 million, day trading every day. Here's this system, do this, do that, pay me a bunch of fees, right? So day trading, unless you're very, very good at it, you will lose all your money. And yes, the volatility makes it fun. So if you approach it as an entertainment situation, like you go into the casino, you're going to play craps, you're going to lose money, but it's fun. I'm going to have some drinks, hang out with my friends. Approach financial markets like, okay, I'm going to go trade on my brokerage account or my crypto account or whatever, creates some meme coins. I'm having fun. My price of fun is the $1,000 that I'm going to lose over time. But it's fun because I know, yeah, maybe if I get really lucky, it could turn into $1 million. But over time, I'm going to lose $1,000.
Hayes concludes by reflecting on the philosophical implications of Bitcoin. He views it as a response to the unnatural suppression of volatility by governments and central banks. Bitcoin represents a return to a more organic financial system where volatility is embraced as a driver of innovation and growth. By offering a decentralized, deflationary alternative to fiat currencies, Bitcoin challenges the traditional notions of money and power.
He is essentially issuing dollar-denominated bonds and, I guess an infinite supply if he can, and buying Bitcoin. And every 3 to 5 years, he needs to roll over a certain portion of his debt. And if his stock price is below the conversion price of his convertible bonds, he might have an issue. So yes, he wants the market to believe it's a physical certainty, because then you're not going to question the ridiculous price that you're paying for his stock. I'm more in sort of the cultural phenomenon sort of camp. For humans, we're going to in the short term, we're going to say, oh, wow, Bitcoin's 1 million, 100 million, whatever the number is. This is a physical certainty. This is the last cycle ever. You hear those sorts of things on the internet. But at the end of the day, we'll get ahead of ourselves. We'll forecast some crazy dystopian scenario, some crazy hyperinflation. And then if you start to underperform the craziness, then the price of Bitcoin looks a little bit high. Maybe it comes down a bit. And so I think that markets go up, markets go down. We as humans, we're over optimistic and over pessimistic. We're not at that stage yet, but I definitely could see at a point in the cycle where we believe that there is no way that fiat currency could ever fix any of these problems. Therefore, Bitcoin is going to infinity. You'll hear people saying this is the last cycle and all this kind of nonsense. And then the price will dump 90%. So I am more in the sort of cyclical nature of markets. That's the physical certainty in my respect, based on human nature. We live in a volatile universe. Volatility is our friend. Suppressing volatility is not natural. And so government says, hey, through my ability to have legalized violence and kill people because they don't follow my rules, I'm going to protect you. And so let me smooth out that life curve for you. Do what I say. Is essentially the name of the game for any type of government. And there is some benefit to that, but take it to the extreme, which is what central banks have done over the past 50 years or whatever it is. Then you start to get into this unnatural state where the volatility is so low relative to what the natural ebbs and flows of life in this universe are. And then things just blow up. Right. And so you think you're safe, and then you get a 2008 housing crisis, or you get, the European crisis in 2011, or you get the regional banking crisis in the US in 2023. And these are all symptomatic of governments saying, we're just going to print a bunch of money and suppress volatility. But volatility is natural. We want volatility. We want to construct a situation where we have volatile upside outcomes with capped downside. And that's really the goal. And so that's what Bitcoin and crypto really represents. Is there's this outcome where all the fiat money in the world needs to come into Bitcoin. Obviously, that's not going to happen, but you can think of that as sort of the extreme example. And your cost is the price that you pay today for Bitcoin. So some people paid $1 for Bitcoin back in 2010, and if they held on, now it's worth 104,000, right? But the most it could ever lose was $1. And so why wouldn't you take that bet? You know how much you're going to lose. It's the amount of fiat currency that you sold to buy Bitcoin. And so you can sort of self-select your risk profile based on your own situation. But there's always an amount of money that you can willing to lose to earn the $10,000, $100,000, $1 million X return on something like Bitcoin.
Hayes sees Bitcoin not just as a financial asset, but as a cultural phenomenon that empowers individuals to reclaim control over their wealth. Its transparent, immutable nature stands in stark contrast to the opaque and manipulable systems of traditional finance, making it a beacon of hope for those disillusioned with the status quo.